You think European banks are recovering? You saw the stock prices surge. You heard the analysts call it a comeback. You watched the green numbers flash across screens and felt the relief wash through markets. You're watching a performance, and the people orchestrating it already know how it ends. They're not buying the rally, they're selling it to you. And while you're celebrating the rebound, the credit pipeline that keeps the real economy alive is going silent. European bank stocks rallied hard. The charts looked perfect. The momentum was undeniable. Financial media declared stability restored. Investors piled in. The sector that was supposed to be broken suddenly looked like the trade of the year. Except nothing underneath changed. Lending didn't increase. Loan demand didn't recover. Credit creation didn't accelerate. The banks made money, but they made it from interest rate spreads, not from doing what banks are supposed to do. Not from lending, not from financing growth, not from pumping credit into businesses and households that need it. They made money by sitting on capital and collecting the spread between what they pay depositors and what they earn on reserves. That's not banking, that's accounting. And you're calling it a recovery. This shouldn't be happening. When bank stocks rally, it's because lending is improving, because credit is flowing, because the real economy is growing and banks are the intermediaries capturing that growth. The stock price is supposed to reflect future earnings from future lending. It's supposed to signal that businesses are borrowing to expand, that households are borrowing to consume, that credit creation is accelerating and the banks are positioned to profit from it. That's the normal sequence. Price follows fundamentals. Stocks reflect reality, but lending volumes are flat. In some regions, they're declining. Small business credit applications are being denied at elevated rates. Corporate borrowing is sluggish. Consumer loans are contracting. The credit pipeline that's supposed to feed the economy is barely flowing. And yet, bank stocks are surging. The disconnect is glaring. The stock market is pricing in a recovery that the credit market says isn't happening. One of them's lying. And it's not the credit market. This keeps happening. Every week, new data confirms it. Bank earnings reports show strong profits. But when you dig into the numbers, the profits aren't coming from loan growth. They're coming from net interest margins, from the spread, from the mathematical result of central bank policy creating a gap between borrowing costs and lending rates. The banks aren't working harder. They're not taking more risk. They're not expanding their balance sheets. They're just sitting in the middle of a rate environment that pays them for existing. And equity markets are treating that like sustainable growth. It's not sustainable. It's extraction. The banks are extracting value from the interest rate structure without creating new economic activity. They're profiting without lending, without risk, without the actual function that justifies their existence. And the moment the rate environment shifts, or the moment investors realize those profits aren't backed by real credit creation, the rally collapses because there's nothing underneath it. No loan book expansion, no credit growth, no real economy activity to justify the valuation, just a spread that could disappear with one policy change. The credit data is screaming. Loan volumes to small and medium enterprises are stagnant. These are the businesses that employ most of Europe. The businesses that need credit to survive, to grow, to hire, and they're being starved. Applications are up, approvals are down, banks are sitting on capital, but they're not deploying it. They're keeping lending standards tight. They're demanding more collateral. They're rejecting borrowers they would have accepted 2 years ago. And while they do this, their stock prices are climbing. They're being rewarded for not lending, for hoarding capital, for playing defense while the real economy deteriorates. This benefits someone. It always does. Equity traders who got in early are winning. Fund managers who rotated into financials are winning. Analysts who called the rally are winning. They're collecting gains on bank stocks that are rising for reasons that have nothing to do with banking. And they know it. They know this rally is built on a temporary rate environment, not on credit creation, but they don't care. They're trading the momentum, not the fundamentals. They're riding the wave and planning their exits. And when they exit, they'll exit into your buy orders You'll be the one holding bank stocks at peak valuation while the credit pipeline continues to die. The regional economies are bleeding. Small businesses can't get loans. They can't expand. They can't invest in equipment. They can't hire. They run on thin margins and need access to credit to manage cash flow, to bridge gaps between payment cycles, to survive the normal volatility of commerce. And that access is being choked off. Not because these businesses are failing, because the banks don't want to take the risk, because lending requires underwriting, monitoring, potential losses, and sitting on reserves requires nothing. Just time, just patience, just collecting the spread while the economy outside starves for capital. This hurts you. Directly. Immediately. If you run a business in Europe, you're watching bank stocks rally while your credit line gets pulled. If you work for a company that needs financing to expand, you're watching those expansion plans get delayed or canceled because the banks won't lend. If you're employed by a small business, you're watching your job security erode as your employer can't access the capital needed to stay competitive. The bank rally isn't helping you. It's happening at your expense. The banks are profitable because they're not serving you, and the market is rewarding them for it. Here's the mechanism that's killing you. Banks are supposed to be the transmission belt between savers and borrowers. They take deposits and transform them into loans. They assess risk and price credit. They connect capital to opportunity. That's the function. That's what makes the economy work. But when banks can make more money by not lending, by just holding reserves and collecting the spread, the transmission belt stops. Capital doesn't reach opportunity. Savers earn nothing. Borrowers get nothing. And the banks extract profit from the gap. They become a blockage, not a conduit. And the economy suffocates while their stock prices climb. The lending standards are tightening even as the rally accelerates. Banks are demanding higher credit scores, more collateral, longer track records, stricter covenants. They're making it harder to borrow precisely when borrowing is most needed. And they're doing this while reporting record profits, while paying bonuses, while buying back stock. They have the capital, they have the capacity. They're choosing not to lend. And that choice is being validated by equity markets that only care about the profit number, not where it comes from. Every single participant downstream is feeling this. Construction firms can't get project financing. Manufacturers can't get working capital lines. Retailers can't get inventory loans. The arteries of the real economy are constricting while the heart, the banking system, reports perfect health. The disconnect is complete. The system is splitting into two realities. One where bank stocks soar and executives celebrate. Another where businesses close, projects get canceled, and employment freezes because credit isn't flowing. The credit pipeline isn't just slow, it's reversing. Loan maturities are coming due and not being renewed. Credit lines are being reduced. Businesses that relied on rolling over short-term debt are discovering they can't. They're being forced to pay down balances, to shrink operations, to cut costs, and the banks are taking that cash and sitting on it, building reserves, strengthening balance sheets, preparing for something. And while they prepare, the real economy contracts, not dramatically, not in a way that makes headlines, just slowly, quietly, one denied loan application at a time. This won't stop, because the incentives are locked. As long as banks can earn safe profits from the rate spread, they have no reason to take lending risk. As long as equity markets reward those profits regardless of source, they have no pressure to change. As long as regulators focus on capital ratios instead of credit creation, they have no obligation to lend. The system is aligned against you, against borrowers, against the real economy, and in favor of the banks doing nothing except collecting the spread and watching their stock prices rise. The rally is accelerating exactly as the credit crisis deepens. That's not a coincidence. That's not a paradox. That's a signal. The equity market is front-running the recognition that these banks don't need to lend to be profitable, that the old model, risk assessment, credit creation, economic intermediation, is dead, that the new model is sit on capital, collect spread, Avoid risk, maximize share price. And if you're an equity trader, that model is great. If you're anyone else, it's a disaster. 1 week credit report breaks this. 1 quarter where even the spread profits disappoint. 1 moment where investors look past the earnings headline and see the loan book shrinking. 1 analyst note that points out these banks are profitable precisely because they're not banking anymore, and the rally reverses. Not slowly, not with warning, with the violence of a market that realizes it's been pricing in a recovery that never started. That's been buying a rally built on the opposite of what banks are supposed to do. The European credit market is signaling the next crisis right now. It's signaling it in flat loan volumes, in denied applications, in tightening standards, in businesses that can't access capital, in regional economies that are slowing because the credit they need isn't reaching them. But equity markets aren't listening. They're looking at bank profits, at rising stock prices, at a rally that feels like validation, and they're missing the contradiction that's about to destroy them. Banks don't rally while credit dies unless something is fundamentally broken, unless the system has detached from its purpose, unless profit can be extracted without function. And when that happens, when banks become profitable specifically by not doing what banks exist to do, the rally isn't a recovery signal. It's a warning. It's the market pricing in the end of banking as economic intermediation and the beginning of banking as rent extraction. And that transition doesn't end with everyone winning. It ends with the people who need credit getting crushed, while the people who own bank stocks get rich, until the moment the contradiction becomes undeniable and the stocks collapse too. You're watching the final repricing before the fractures show, before the loan defaults start appearing, before the businesses that couldn't get financing begin failing, before the employment data reflects the credit contraction, before the regional GDP numbers confirm what the credit pipeline has been screaming for months. You're in the gap between perception and reality, between stock prices and credit flows, between the rally and the crisis it's hiding. The banks are making record profits by refusing to lend into an economy that desperately needs credit. And the equity market is celebrating that refusal as if it's strength, as if it's prudence, as if it's the sign of a healthy system. It's not. It's the sign of a system that's abandoned its function and is harvesting the last profits before the collapse. And you're buying into it. You're looking at the green numbers and feeling optimistic while the credit pipeline that keeps the economy alive goes completely dark. The next credit report will tell you everything. It will show whether lending has finally started to recover or whether the contraction is accelerating. It will show whether banks are deploying their capital or hoarding it. It will show whether this rally is built on anything real or whether it's just traders passing positions to each other while the real economy deteriorates underneath. And when that report drops, one of two things happens. Either the market wakes up and the rally collapses, or the market ignores it and the rally continues, which means the disconnect grows even larger and the eventual correction becomes even more violent. You're holding assets in a banking system that's profitable specifically because it stopped banking. You're trusting a rally built on credit destruction. You're positioned for recovery in a market that's actively contracting. And the distance between where you think you are and where you actually are is measured in loan applications that will never be approved, in businesses that will close because they couldn't access capital, in jobs that will disappear because companies couldn't finance expansion, in regional economies that will slide into recession while bank stocks hit new highs. The credit pipeline is dead. The banks killed it. And they're being rewarded for the murder. While you stand there watching the rally, wondering when the recovery starts, it's not starting. It's ending. And the banks are sending you the bill disguised as a buying opportunity.